Welcome to the Jess Larsen Show on innovation and leadership, where I interview all sorts of people I'm interested in. And this episode, it's Eric Chan. Eric, Aura's pretty impressive. Why don't you tell us a little bit about
Yeah, so Aura's a $1.3 billion funds under management asset management firm. We cover alternative investments, mainly venture capital, private equity, and alternative credit. We're spread across Australia and Southeast Asia with offices in Sydney and Singapore.
So, that those are some pretty impressive numbers. How long did it take to get that kind of AUM?
12 years. So we started back in 2010, and definitely the growth was not linear. It was, there was definitely a bit of a J curve. Most of that growth probably came through in the last sort of 6 to 7 years. And part of that was our expansion into Singapore.
Okay. So, how much was it in the early years?
So we probably, we obviously started at zero, and then our first fund that we launched was back in 2013, and that was only a $3.5 million fund. It was a single asset fund for one single investment, and that kind of became a bit of our playbook in the future and how we raise money. And then we probably were about a couple hundred million for first 5 years or so, and then it really took off thereafter.
Do you remember how many years it was when you passed the billion mark?
It would have been 2 years ago.
Congrats.
Thank you.
Uh, so, my very first question is, there's so many folks in the industry that would like to have those kind of numbers that don't. What are some of the things that you think you've done different that's attracted that kind of assets?
Yeah, definitely. So I think part of it is definitely creating a point of difference in the products um, that you launch. For us, we started in venture capital in Australia back around 2010. Actually, when we started our business, we weren't in a funds management business. We were actually a corporate advisory business. We've always the ambition to be an investor, but we knew back in 2010, both my co-founder and I, we didn't have a track record. We didn't have a brand, and we probably look a lot younger than we were. And we were running around town trying to raise money from high net worth individuals. And we just knew it was going to be very, very difficult. So we started as a corporate advisory business, advising early stage startups. And then when we built a bit of a presence in the client base, we went into asset management, did our first fund in 2013. And from there, we grew it as a fund management business. But, our passion has always been in venture capital, but we knew over time that it was very difficult to just stay in venture capital, especially really early on when people were only allocating very small amount of their capital, of the whole portfolio in VC. And also we acknowledged there was a risk in our own business where, VC, it's great when the market is growing and everyone wants to invest in high growth investments. But when the market is bad, like right now, it's very difficult and people will tend to be more conservative and want to invest into sort of, happy to take lower yields, but, be more capital preservation. And that's why we started expanding into other strategies. And we just thought, what's more, we're already at the most extreme end of the spectrum. Let's go in the safest end of the spectrum, which was credit. And then we expanded into also private equity, which was in the middle thereafter as well.
There's so many interesting things to pull out in there. Why do you think that so few firms recognize what you did about the cycles and that you're going to want something to cover for when the market turns?
Yeah, look, I think, and there's no, perfect answer to actually, or a perfect way to actually launch a funds management business. But there's definitely certain people which will just fully focus on venture capital. You have a lot of these very successful VC firms. And that's important when you're wanting to build a brand and presence around VC, and you want to demonstrate to your LPs that, that is what you're really good at. And if you ever want to invest in the VC, that's what you should come to me. But then, for, other people where they are diversifying in other asset classes, they don't get that kind of benefit, in terms of being focused. So you typically often get investors or LPs where they question whether, should I be investing in someone that's a little bit more, I guess, specialized, or someone that's a little bit more general? Um, and then for us, what we all, I guess we acknowledged that as we were growing our business. And we did do other strategies as well, but we decided that actually, we do need to be more focused, and we kind of pulled back a lot of some of the other strategies that we were doing, and just dropped them. And then kind of reminding ourselves that we just needed to build squads within each of these strategies and have no single team kind of crossing over multiple strategies, so that we are building, I guess, individual business units, covering each strategy within the business, so that when people think about us from a venture capital perspective, we are the venture capital firm that people should allocate money to, as an example.
One of my business heroes is David Rubenstein, one of the co-founders over at Carlisle. And he talks about just like how much people made fun of him when he first started doing this. And they called him like the McDonald's of funds because, he started in leverage buyouts, became PE, but then he's like, he realized that his customers were also looking for debt opportunities and some credit exposure. And so they went out and recruited credit experts to come run that. Then they wanted venture, so they recruited venture experts to come run that for them. And he was like he was like being made fun of until Blackstone and everyone else in the world started copying them because it works, right?
Yeah, absolutely. And I think the other benefit of what we're doing is that, you know, we cover, I guess, a wider life cycle of our founders, right? So, we cover already obviously the early stage of their life cycle through our VC. But as they get bigger, when they need a credit opportunity, there's potential for that from through our credit teams. And then, or if they kind of get into a much larger stage, if they want to IPO, et cetera, then that's when our private equity team could come in as well. So we kind of cover the, I guess, investment requirements for our founders throughout their whole life cycle.
Yeah, and then post exit, get them with that cash, right?
Absolutely. Actually, a fair few of our founders are actually LPs in our fund as well.
That's fun. So, you know, I definitely get more Americans and folks in the UK and Europe on here. Uh, I'm not sure everybody recognizes just how many great companies come out of Australia. I was lucky enough to have one of the co-founders of Canva on the show, and you know, I think Cameron and those guys were the first venture-backed billion-dollar unicorn, right?
Yeah, that's right. I mean, the other well-known unicorn that came out of Australia is obviously last year, but they weren't venture backed, right? And you're right. I think, and it's actually more so in the last few years where we're starting to get a few of these unicorns come out of Australia, where people are taking notice. But Australia's been a great environment for launching technology, right? I mean, Wi-Fi came out of Australia, as an example, which a lot of people don't know. And one of the risks that we identified when we got into venture capital really early on was actually the lack of liquidity in Australia. For example, the point, like a lot of overseas VCs weren't investing into Australia. And what can tend to happen was that, a startup in Australia will often outgrow the capital capacities of Aussie VCs. But then they weren't big enough, or they haven't shown enough tractions in the US or in Europe, and in order to attract capital from offshore VCs. And they were also not really kind of looking in Australia. But in the last few years, we're obviously seeing like guys like Tiger, Sequoia, GGV, et cetera, all kind of, I guess, looking for opportunities in Australia because they've now noticed that, great companies do come out of Australia as well.
Yeah. Um, I I love Australians. They're fun. They're funny. They don't take themselves as seriously as some other places. Uh, and they're just like welcoming. I'm wondering. This is according to Jess. Uh, but I'm wondering what kind of advantages you think that gives for startups to have that kind of a culture.
Yeah, look, it definitely allows you to just give things a go, right? In Australia, so I've noticed a lot of Aussie founders, they're great young guys that haven't even thought twice about running a startup. They just left their jobs and they come out and they just give it a go, and everything they do, they just give it a go. Um, Definitely a lot more relaxed in terms of, finding the need to demonstrate um, their um, finding the need to demonstrate whether they can do it. They just kind of take the leap of faith and actually just give it a take find the opportunity and just give it a chance. So I hope some of those kind of characteristics actually has helped push a lot of, I guess, individuals kind of just come out and just start a startup.
Which is funny when you think about like there can be negatives of not thinking hard enough about what we're doing, but how many of our regrets in life are from what we didn't do? So many, right?
Yeah, absolutely. And you're right, because I think you know um, early on in the days when I first started my business back in 2010, one of the best things I ever did was actually just go, you know what, like there's no better time to actually start this business. As I get older, as I get more responsibilities, it would just get more difficult. So I might as well um take the leap of faith now. And my advice to people during that time was always, just give it a go. There's no downside, right? You can always go back to if you're good at your job, you can always go back to your job and someone will hire you. Um, but nowadays, it's actually so easy to start a startup. People often forget about, thinking through, am I solving the right problem? Do I need to solve this problem? And they just dive straight into building product, right? So you're absolutely right from that perspective.
It's like a balance beam where it's so easy to underdo it or overdo it, right?
Yeah, that's right.
Um, and I know you have offices all over the place. What city are you out of?
Sydney.
Is that where you grew up, or where did you?
Yeah, I grew up in Sydney. Migrated here when I was 5 with my family, and then just did all my schoolings in Australia and built my business initially out of Australia,
Oh, where did your family come from?
Hong Kong.
I'm interested. You know, we hear so many stories about you know immigrants are 4 times as likely to become millionaires, at least in America. Uh, and I'm interested in what kind of advantages you feel like growing up in the family you grew up gave you.
I think what I definitely learned through my experience was that you need to take every opportunity presented to you and to just give it a go. And also, you need to work hard to get what you want to achieve. And I think that's also a bit of a cultural thing, right? As I was growing up, I would watch my dad go to work every day. I mean, even till now, I think he's in his late 60s. He still works 7 days a week to the point where I don't think that he can stop working because he's just so in love with it. And at the beginning, he was like, because that's what he had to do. If I don't work 7 days a week, if I don't work hard, how am I going to afford to, pay for everything that I need to pay for my family and move them to a country. And then also, because when we moved over there, it was during this period of time where, I called it the Great Migration because, everyone in Hong Kong was worried about what will happen after 97 when China would take back over Hong Kong. And there was a lot of fear and people would just, I guess, migrate into other countries. But the problem was, um, a lot of the income was coming from the dads, right? So the dad will often stay back in Hong Kong, and the rest of the family, the moms will take the kid and migrate to a different country. The bravery from these mothers, my mother, right, in taking 3, 4 kids outside of her own comfort zone into a country where she didn't speak a word of English, to raise us purely just because it was the best thing for us. Like, there's a lot of learnings from that I took from what my mom and my dad actually gave up for to give us a better life.
It's so easy to discount that bravery looking back when it all worked out.
Yeah, that's right.
But think about entrepreneurship and investing and the requirement to be able to deal with uncertainty. I mean, your mom was dealing with major uncertainty there, right?
Yeah, absolutely. I mean, like, if I look back, like, she would have had great characteristics as a good founder.
No kidding. Before we move on, what's one other trait you admire about your mom?
She's passionate, she's loving, and she's caring. And I think I picked that up from her in sort of my way of life, which is you treat people not the way that you necessarily want them to treat you, because you just treat them the best that you can and don't sort of ask for anything in return. Because if you treat people expecting them to treat you the same way, then you could often get disappointed. But then also, then you're not really doing it for them or for the benefit of them. You're doing it really for yourself because you want them to treat you better.
Motivations matter, don't they?
Yeah, absolutely.
Um, so how big is your team these days?
So we're a team of about 52 people now. Um, about half of that's in Australia and half of that's in Singapore.
When you think about expanding internationally, it's something that can be quite scary to CEOs and founders or fund managers or people like that. Um, Making that leap and like, heading over to Singapore, what kind of lessons do you have for the rest of us who haven't done something like that yet?
The lesson I took was you had you have to have one of your founders be in the region. Like, so we how we started was we knew that Southeast Asia was a great region to expand into, because we just acknowledged it as, the fastest growing growth corridor around the world. Um, and it was beneficial not only for us from a deal flow and investors perspective, but also we figured that it was a great place to build networks so that we could help our founders expand into that region even when they want to. But when we first started, again, there was a bit of uncertainty whether it's the right thing to do. So we basically hired someone to basically lead to grow a beachhead out of Southeast Asia in Singapore. Um, which was great. Like the guy, he's still a very valuable part of our business. He was great. But where we really started taking off was when one of my co-founders moved into Singapore. And it wasn't it wasn't a, I guess, a reflection of that we didn't have the right team over there. I just think that, you need a founder mindset to build a new to start a new region, because it's almost like starting a new business, right?
That's really insightful. Um, I'm interested. I think sometimes I've had people in my life who have kind of looked at some of my co-founders and thought that, maybe their skill sets weren't as important as mine. And they say, "Oh, why do you have those co-founders? You don't need them, Jess." And things like this. And so my brother and my mentor, starting back 21 years ago, John Verhessen, we've done all these different things together. We made a lot, we lost a lot, we made it back, we lost it again, we made it back. Like we've just been through the ringer together, right?
You know,
And for me, I have a hard time describing like why I don't want to do anything without them. Like I can hire lots of employees, but I can't hire that co-founder mindset. How would you describe a co-founder mindset?
I believe it's the trust that you have with your co-founder, because it's great to have complementary skill sets, but great co-founders are ones where you also have, I guess, different perspectives and views on things. And sometimes you often get into a position where, you've just both don't agree on the same thing. And it gets to a point where you just have to trust the other person and allow them or allow you to to follow one path, right? Because otherwise you just kind of get stuck in one position, and it's in a stalemate position. And if you've only just met someone and you kind of brought them in as a co-founder, it's very difficult to build that trust with that person immediately. But even with my co-founder, I've known him since I was 14, right? I met him when I was working at a KFC down the road from his place. And, he used to come over and trying to get free chicken from me. And since then,
It sounds like
and
an entrepreneur.
yeah, and then since then, like, we've been great best friends. We've done a bunch of side hustles when we were growing up. And I just know that, even if I disagree, and if I kind of just sit back and go, okay, this time you go with let's just go with what you think. I can trust, whether it's right or wrong, I can just trust him to do the best that he can, and I can just trust his perspective on things. And I think that trust is very important, and you just don't get that with anyone. And it's definitely more important than having someone that have a different skill set or have a specific skill set, if that makes sense.
Yeah, we have a code word for it that my brother invented. He says he calls it a hill to die on. He's like, "Is this a hill to die on for you?" Or he'll be like, "This is a hill to die on for me." And that's like
Yeah.
signal
Yeah.
like, how much do you mean it? Because I really mean it. And like it's almost like a marriage in ways where it's like, you know what? I can give him this one. Like I disagree, but I don't think it's gonna wreck the company.
Yep.
And I'm willing to take it on faith and I'm like, you can take this one, you know?
Yeah, absolutely. And, sometimes I feel, sometimes I have met co-founders where, they've just met each other because one person had the idea and he's like, okay, I need a technical co-founder. And I just go around and, I met this guy at an event and I just brought him as a co-founder. I thought he was great because he was also interested in my idea. There, I always feel like you said, it's like a marriage, but it's also like, you know, it's like living with your partner before getting married, you know. And if you've never, you've seen so many relationships where they haven't lived together and they break up because they've just discovered things about them that they don't love after they live together, and then the marriage kind of breaks apart. It's similar to like just finding a co-founder at an event that you met for a month or 2 months, and you decide to go on this lifelong journey with them, right? It's very, very difficult. I mean, some do succeed, but it's a roll of dice, right?
Well, um, I heard somebody say it that sharing a bank account is fertile ground for growing a disgruntlement. And like this idea of like, is there any way for us to get to date before we get married? Can we do a joint venture? Can we do a profit share? Can we, can we do something together before we like literally share a bank account?
Yeah, yeah, no, absolutely. And even my co-founder and I mentioned before that we've done a bunch of side hustles all the way leading up throughout university, and we kind of learn a lot about each other through those side hustles. I mean, they weren't big businesses, but it definitely allowed us to learn about each other.
Yeah. So, my next question is about scale.
Mm.
Um, Tell us about some of the big learnings going from managing 3.5 million in that in your first special purpose vehicle
Yep.
up to 50 people managing over 1 billion.
So, I'm a big believer that you don't need to be the best person at everything as the founder. I do believe I guess, as the leader in the business, it's about building or putting smarter people around you, to help you grow that business. But one of the biggest learnings I had was actually hiring people just based on their CV. Like we were starting to scale our business, and we just knew that we needed people with a lot more experience, and that's done it before, right? But we kind of took that into, and which I still believe in, but we took that interpretation as we just needed to find someone that worked at big fund managers, that has led big teams, has managed a lot of money, so they must know a lot. And we did, and that's what we did. And the problem was they just had a completely different culture to us, and they just did things completely different to us. And for us, that actually crippled our culture and it crippled our business a lot, because when you put someone like that into the business and you entrench them, it's very hard to take them out. Because once you hire this person, obviously you have a conviction in this person will help you grow the business, but you also have to convince your team that, this is a person that's going to help us grow the business. And you kind of have to give him the time to actually do that. But then at the same time, it's once you kind of know if he's not the right person, it's also very hard to just go, actually, guys, I was wrong. I'm just going to take him out of the business. And let's go back to the things it is after I've done a bit of a dance about how good this person is. But the reality is we were wrong in terms of hiring this person just because he was like, very senior and executive at like one of the largest banks in Australia, because he just didn't do things similar to the way that we did it. And he didn't have the right culture in, that we kind of, created in the business.
Yeah. How do you navigate that when you realize we need to bring someone in from the outside, um, and yet we're worried about not having a culture fit?
So, nowadays we're very cautious when we hire senior people. Um, we often will, um, for us, like the experience is important, but we actually court with a person for a much longer period of time before we hire that senior person. And, there's been like someone more recently, like we literally had courted for 6 months. So he wasn't even looking for a job. But we were basically just speaking with the guy for over a 6 month period, had we'll go out for dinners, we have beers, just to build our relationship. Because we knew that if and when he wanted to go out, he'll be the perfect person for us for a specific role in the business. And that gave us a lot of the comfort. Now, obviously, there's certain times where you kind of need that person now and then, but that person was, it's hardly like a very senior person, right? So we're typically trying to look 6 to 12 months ahead in terms of, okay, what is the next senior hire that we need? And then start thinking about, talking to people, meeting people, and start thinking within our networks who that person could be and start building those relationships today. Because what we don't want to do is just get a recruiter where they're showing us a bunch of CVs of guys that have 20, 30 years of experience, which looks perfect on paper but just not perfect fit. It's sort of like with founders, right? Like, it's very difficult to go, I met a founder, we've had two pitches and I go, okay, I want this guy, I want to back for the next 10 years, right? Which is why even with founders, we try to meet founders even when they're not raising capital and try to build relationships with them to understand what they're like as a person, as a founder, before we actually invest into them. To the extent that there's some founders that we would have backed maybe 4 years after we first met them, and it may not even be the startups that they were running at the time. It's a different startup at the time we backed it.
That's so great advice. I didn't know what you were going to say, but I think my mind was going a little bit more towards like the interview process or things like this, and your answer is just so much more realistic. I really like that answer. Really
Yeah,
actionable.
yeah. I mean, like, there's definitely certain things that you can pick up in interviews, right? Because I think once you've done enough of these interviews, you just know when someone has, you know, staged an answer that you want to hear versus an answer that they genuinely are telling you from their heart.
So important. Um, a subject, we have so many different entrepreneurs and investment fund managers and people on the show. And something that I feel like there's an insatiable appetite for, people can never get enough information on, is fundraising. Um, when you think about uh, lessons you've learned, what are some things that have evolved for you over the years when it comes to attracting more LPs to choose you guys?
So what we do is, because when we started, it was a lot of high net worth family office money. That's where our LP base initially started from. Um, and then as you're moving into sort of more institutional world, again, like the institutional investors are people that you need to build relationships much longer before they will invest into you. So even before we even think about starting a fund, if we think that we're going to be launching a fund in 12 months time, we'll start that activity 12 months prior in terms of meeting these institutional investors and build relationship. Um, the other thing that is important is, for me with LPs, like there's no, it's never bad to overshare in terms of sort of portfolio updates or performance, etc. And as an example, when COVID hit, and the market, and there was a lot of uncertainties in the market, and obviously certain industries were doing worse than others. So certain portfolio companies were doing worse than others. You know, the importance of the most important thing at that time was actually just keep constant communication with your LP and giving them as much information as possible, so that they're not only just sitting there, kind of second guessing what's happening to their investment. Now, the communication may not always be great news, and often, during a bad period of time, it's often bad news. But that's okay because you're bringing them on the journey on what's happening with the portfolio company or with the investment. And the reality is not everyone obviously knows that there's always going to be good investments, there's going to be bad investments. But what I guess shocks them the most is thinking that something was a good investment and all of a sudden, you actually was a bad investment because I never heard, I never got communicated about that investment for 12, 18 months, whatever it is.
Yeah. Surprises are typically a good thing, right?
Yes, that's right.
So let's go back on that journey. Let's go back a little. When it comes to working with high net worth individuals and you're getting started, what are some of the principles that you have that you would advise others who are working with that community?
Be honest, um, and also be grateful. Honest in the sense that, again, be honest with investors in terms of what the risk profile of that investment is. Be honest with the investors in terms of how the portfolio company is actually doing. And be honest in terms of what went wrong and sort of admit if something, if it was a mistake, or admit that, and just be upfront in terms of what were the learnings that you actually took from that investment. I think a lot of investors will appreciate that. I mean, some may not, but then those people may not necessarily be the right investors for you anyway. And then be also grateful, be loyal to your investors that really backed you really early on where, you didn't have a brand, you didn't have a track record, and be grateful to them for giving you a chance. And I will always prioritize people, those people that gave me my first dollar over anyone else sort of later on, even if they can't write a big enough check.
Yeah, that's so great. Um, well, let's talk about that. What's the smallest check you've ever taken? What's the biggest allocation you've ever taken?
Ooh. Okay. The smallest check I've ever taken is $10,000, which is tiny. The biggest check we ever taken, maybe 15 million.
Yeah. Um, I'm interested to hear what the similarities are because you're still dealing with people who are handing over money who have to have faith in you. What do you feel like is similar, whether you're landing 10 grand or 15 million?
So the similarity between the 10 grand investor and a $15 million investor is that they both want to understand, they they both want to understand the pitch, right? They both want to understand what are they investing in, what is the risk profile of the investment, et cetera. And are you going to make me money, right? Um, but I guess the difference a lot of the times between a smaller investor and a larger investor, it's sort of the amount of due diligence they end up doing after the back of that. One other similarity would often be that the updates that they might want to hear about. Like even after they invest, just because they invested $10,000, it doesn't mean that they're going to go away and then you can just tell me if I make money or not. Um, I think it doesn't. It's not really a matter of how much they're investing; it's how much wealth that investment adds up to be. If you're a billionaire and you invest for whatever reason, $10,000, obviously you're not really going to care, right? You're not going to spend time and effort in understanding that investment, or following up on that investment. But if that 10 grand is 10% of your wealth, then you're definitely going to want to understand like what that investment is. And you're going to pick up the phone, you're going to call the investment manager about, what's going on with my investment.
It's something that I feel like doesn't get talked about enough. We in my late 20s when we started our first fund, we'd done a retail fund, so I had 1,200 investors, you know, and you really get a sense for what people want to know because somebody out of 1,200 is not going to be shy,
Yeah.
and I feel like it doesn't get talked about enough. And it's like what I found is the more we communicated, and this is not a shock, but the more we communicated, or like you called it over communication, the more people could just be calm and live their life. And they were so much better clients of ours when we over communicated up front. And like so many of my problems had to do with not getting in front of that and not giving enough information early enough. I think about, you know, feel like I've had some big wins, but also some major mistakes in my finance career. And some of the biggest ones are somebody got a negative surprise and I hadn't communicated enough along the way. Those are rough spots, you know?
Yeah, no, I totally agree with that. Actually, that's also why I don't, it's one of the questions people always ask me is like, when is the right time for, startups to get listed? Because, in Australia, actually, you'll be surprised. Um, the requirement to listing a company is actually much lower, and the size of the companies typically can be much smaller. So you often see sometimes startups listing on the Australian Stock Exchange, um, where they might be doing, $5 million of annual recurring revenue, right? Because it's just another pathway of actually raising capital. And then so people often in Australia will ask me like, well, what do you think is the right time to invest into for a startup to list on the stock market? And I said, the reality is, I don't think startups should be listing on the stock market until they kind of, no longer should be called a startup because, founders are already fighting fires, every day, fighting 100 fires every day. They're super busy. Um, but part of a listed company, part of a listed CEO or founder is that you're going to have to constantly communicate to the market, right? You have to constantly communicate to research people, which often don't really understand your business, but they just like the idea and they're investing into your business. The distraction that you're going to get from actually being listed because you have to over communicate to the people and to the market and to research houses, it's just going to take your eyes off actually running the business and growing the business and solving those 100 problems that you have every day.
I'm interested. mm, We talked about some of the similarities. Let's talk about the differences. Um, when you're asking for a $15 million check, what's a mindset that needs to change for maybe it's a fund manager or somebody listening today who's like, we have never asked for a check that big. When I get to that level, you know, what should I hear Eric in my ear telling me? Like, what's what's the pep talk? What's the guidance? Do I just need to take a deep breath and prepare for a lot longer due diligence cycle? What's involved?
Yeah, look, I think there's definitely a long cycle of due diligence, but it's also being prepared on that due diligence and having the right infrastructure. Because as an institutional investor, what people are also caring about is, is your business going to is your own business sustainable? Like, are you, as an investment manager, is your business going to be sustainable? Are you going to be around for years? Are your employees or your key people actually getting remunerated properly? Do you have the right back office? Do you have the right compliance? Like stuff that an individual investor may not really care about, but your institutional investors are. Part of the reason also is, institutional investors, they don't want to just come in for the one check, right? Because every time they invest into a new manager, it's actually a lot of resources, a big investment for them. So the idea is always that they want to come in and they will write multiple checks. So they want to also make sure that you as a business is sustainable and that they can continuously to partner and invest into you over time. So long as you deliver the performance. So the questioning that they're going to have is going to be very different. It's going to be stuff more around your business and about your infrastructure, etc. And you do need to be prepared for those type of questions.
And can you give people some examples? Is this just like having a really well thought through data room, having, you know, investor questionnaires, answers pre-prepared? Like, what are some examples of structure?
So I will break down our data room into um, a number of segments. So obviously you have just actually even just overall the business. If you actually think of it almost like, when you go into a data room investing into a startup, right? What you expect there is not too dissimilar with what your institutional investors are going to want to expect. Stuff about your company information, your performance, but digging into actually how your performance has been calculated, your back end infrastructure, your team, etc. Whereas an individual will write you a check off the back of a pitch deck, right? It's really what is the supporting information that is underlying this or that's underpinning this investment presentation that you've provided me.
We've covered a few different topics here. What's a question I haven't asked that I should?
Well, sure. I guess learnings that we've had as a venture capitalist. That's obviously a question people always ask. For me, I mean, the reality is there's so many learnings. even to today, I'm learning something new as an investor, as a venture capitalist, right? But some of the key learnings that I've had over the years is, everything starts with a problem or product, right? You got to build conviction in your founder's thesis as opposed to as opposed to the product that they've built. Because if you believe in the thesis, if you have conviction in the thesis, and you believe in the founder and they have the right characteristics, then their ability to build and ship product is just, part of the process. And often what you see is that the product that they create today is not necessarily going to be the product that solves the end problem. It's just the means and ends, just the beginning of it, right? So I wouldn't dive too deep into the actual product itself, but more into the problem and the founders when you're investing sort of around the seed and Series A rounds. Timing matters. Like, we're always looking at big markets, but and big problems that are trying to be solving. But the reality is, sometimes you could have an obvious problem or a big problem that doesn't need to be solved today because you just know that the adoption rate isn't going to be there. Alternative VC is actually a big example of that, right? Um, and then another example, another learning would be something like, it's important to build muscle memory and identify and being able to identify patterns. But it's also a risk to actually be beholden to those patterns and making investment decisions purely on those patterns.
Let me take it another direction. So, if somebody today is listening from Singapore, listening from Australia, or who's an ideal client for you? Who are you guys perfect for?
So a perfect investor for us, it's someone that um, wants venture capital as a allocation in their portfolio. People that believe in um, thesis investments as opposed to just being specializing to a single industry or sector. Um, and people that are patient with capital, right? Because venture capital is a long game. It might be years before they see return of investments. So they need to be very patient with the capital. And then also, I guess, people that have a belief that, Southeast Asia is a important region. What I mean by that is one of the things that we try to do as an investor is we try to add value to our founders by providing them with access and reach across Southeast Asia, from Australia anyway, Australian founders anyway. Because what we learned over the years was that, you know, often founders will disregard Southeast Asia as a region when they think about global expansion, just because it seems too complicated or difficult for them compared to like the US or Europe, etc. Um, while this, I don't necessarily think that Southeast Asia is also it's the right market for for every or many startups, um, but they need to actually assess the market as part of their thought process, as opposed to just completely ignoring them. And what we wanted to do, and part of the reason why we expanded into Singapore, was actually providing them with the right insights and know-hows in order for them to make the right decision or assessment to determine whether they want to expand into Southeast Asia. And then so that if and when they want to, we want to be there to help them and add value. So for I guess for LPs that believe that adding value via giving them access to Southeast Asia, it's important and it's unique. Those are the right LPs for us.
That's great. You know, a mentor of mine, he's a good friend we've had on the show. His name is Senthil. He runs a leadership training organization out of Singapore, training the biggest banks and the military and all sorts of corporations and stuff. And it is kind of a fascinating place. If you had advice for Americans, Europeans, folks from the UK who are interested in Singapore, what's a baby step? What's a principle that you would maybe tell them to look at if they want to explore the opportunity?
Southeast Asia is definitely a completely different market to most, right? And almost ignore everything that you've learned as what product market fit means in your own region, because most likely than not, it's completely different in Southeast Asia, right? And the first thing you'll probably want to do is understand wherever the problem that you're solving exists in that market, whether it needs to be, um, and whether it needs to be solved, and then understand what the customers in that region actually really care about, and whether they will be paying money for it. So it's almost like launching your startup again, just in the new region.
It's like bringing that beginner's mindset.
Correct.
I love it. Listen, where are the best places for people to find out more about the business or connect with you online?
Yes, I use LinkedIn a lot. And then obviously we've got a website. We've got aura.vc, which is specifically for our venture capital strategy. And then aura.co, it's our group website.
Uh, well, as we kind of wrap up here, what's something you want to leave people with?
Look, I think um, I think people should, again, I've been through this journey for so long now that, I want to pass on as much knowledge as possible to people. And what I could leave with people today is probably that, similar to when I first started off, similar to what we spoke about at the beginning, which is just give everything a chance, but be conscious and prepared before you dive into anything that you do. But don't be afraid of doing it. Just be prepared before you do it.
That's great advice. Well, thanks again for making time for this.
Thanks, Jess. It was great being on. Thanks for
Yeah,
having me.
you bet. Yeah, bye everyone.